Happy Friday. I hope everybody's doing well and enjoying the week so far. Definitely an interesting week. Chapter 4, as we discussed, is um, certainly a chapter that's got some unique concepts. And I really feel like this Unit 2, slows quite a bit. If you looked at the first unit where we covered chapters 1, 2, and 3, a lot of cumulative information, and not that this information is not cumulative, but certainly chapters 1, 2, and 3 is just a lot of information thrown at you all at once. And it feels like, for me, it really feels like this chapter kind of slows a bit. But I wanted to back up for just a minute and kind of talk about the process of closing a little bit, because I really feel like chapter 3 goes into that some, but doesn't really cover that to the depth that I feel like we need to cover. Because as you look into further chapters, and even this one, we have some closing entries to think about. So I just want to talk about that for a minute. I won't use Excel. I'm just talking through the process. But um, if you think about it, in every type of business transaction, we've got permanent and temporary accounts, and we've got some accounts that just are ongoing in nature, and then some that are not. In the very same sense that when you were doing adjusting entries, as you'll recall, we leave the historical value of an asset on the books at what its book value was. So if it was $15,000, then that asset is going to be sitting on the books at $15,000 indefinitely. And then the devaluation of that, or the book value of it, is going to be the accumulated depreciation that we build. And we do that for a specific purpose. If we do that adjustment, we've got initially one asset that we're buying, and we're giving up cash, and we're purchasing equipment or land or truck or whatever it would be that's going to be a long-term asset. And then with each month of use, we are recognizing accumulated depreciation, which is a contra asset. It runs contra, or opposite of the asset itself. And then the other side of that entry is a debit to depreciation expense. And so with each month, we're recognizing devaluation, and we're recognizing usage, and then we're recognizing the incremental expense each month associated with the devaluation of that asset. But those types of accounts are ongoing in nature. They exist for a long period of time. Some assets exist for an indefinite period of time. Land is going to be land for a long time, for instance. And so it's important for those assets to continue on. We want to make certain that whenever we close the books for a specific period, whatever that may be, that the assets remain on our books, right? We would love to be able to get to the end of a period and say that we no longer owe anything, but our creditors would not like that. Certainly, if we owe them money, they would like to get paid, as we would if we extend credit to others. So our liabilities are also ongoing in nature. And then lastly, our equity is going to be our net worth. And as we've talked about before, if you have a business that is making money from its operations, then it makes sense that your retained earnings are going to grow. It makes sense that your business equity is going to grow. If you're losing money, on the other hand, it makes sense that it's going to contract. If you're paying out a lot of dividends, it makes sense that you're going to contract. One account that wasn't really touched on, and I want to mention this as well, because this is also has an equity effect, is a drawing. If you're a proprietorship, and you take, say for instance, you go back to the original accounting equation, assets equal liabilities plus owner's equity. Drawing would be a contraction of owner's equity. So for instance, if I invest $100,000 into a business, and I take $10,000 out for personal expenses, whatever that would be, I would then have a credit to cash because I'm taking the cash out. I would have a debit to owner's equity because I'm pulling my portion of that equity out. So in a way, it behaves somewhat similar to how dividend distributions work, where it's going to be money coming out of equity, but instead of it being paid out to shareholders, I'm taking, as the owner or investor, I'm taking this out myself. So whereas dividends are a result of the product of earnings, we make money, and therefore we can distribute a dividend portion to entice investors to either stay with us or to invest more in us. An owner's draw would be a situation where I'm taking money out for personal uses as far as that goes, and the business no longer has access to that money. So I say all that to say our temporary accounts, our revenues, our expenses, the new account income summary, drawing, dividends, these are all things that have to be closed out after each period. So when you were doing a post-closing trial balance, one thing that you should have seen when you got to that point is you did all of your adjustments and your closing entries would have been opposites. So for instance, if I look at revenue, well, revenue should have had a credit balance at the end of the period, whatever that would be. I would have a credit of some number of dollars that would be reflected in my revenue. The opposite entry to that would have been a debit, because at the end of the day, I've got to clear revenue out. I have to begin the next period with a zero balance in revenue, because I don't want to end up, if I were to carry revenue over, I would essentially be double counting in the next cycle as far as that would go. So it's got to be debited. And then the credit is going to be to a temporary equity account called income summary. An income summary is basically nothing more or less than a temporary holding account, and it's going to be in and out very quickly during the month. So revenue is then debited to the revenue accounts. The credit is going to be the income summary, and what is sitting in income summary should match what I had previously in revenue. Same thing for expenses. My expenses had debit balances. I need to have credits to each of those expense accounts to zero them out so that I can start the next period clean with a zero balance. And those debits are then going to be reflected in income summary. And so when that's all said and done, a good self-check would be the net income that I had prepared in my income statement prior to closing. That net income balance, the difference in my revenues and expenses, should exactly match what I'm now showing in income summary. Okay. And so if I've got if I had net income, I made more money than I lost, then that would be a credit balance. I would have more revenues and expenses. So say, for instance, I get to the end of the period, I have a $5,000 credit balance, the difference in my revenues and expenses. That $5,000 credit balance should now be reflected in income summary. Okay. The entry to close income summary is going to be a debit to income summary in that instance, because if I had a credit balance, I need a debit to zero it out. The credit is going to be to the equity account. Because I have made money, I have to zero income summary out. I can't go in the next period with a balance in income summary. It's got to be cleared out. So to do that, I would debit income summary, and then I would credit equity. And that's going to allow equity to grow as a result of my operations. The opposite would be true if I had a loss. If I had a loss, then I would have more debits or more expenses than credits or revenues. In that instance, income summary is going to have a debit balance because it would reflect the net loss that I was calculating. Okay. So to get that cleared out, I'm going to have a credit to income summary for the amount of the net loss, say $5,000 again. Then my debit is going to be to equity. And that is going to have the effect of taking down the overall value of my equity, which is what we would anticipate in that instance. And so at that point in time, when I perform those entries, either that be a net income or net loss, I've zeroed out my expenses and my revenues. I've zeroed out my income summary. And so at this point in time, that's probably the most confusing part of the closing process. I then only need to look and see if I've had dividend accounts or drawing accounts. If I've had an owner's draw during the period, I directly debit the equity account, and then I directly credit cash. Okay. Or if an owner had a piece of equipment that he or she was taking out that had a value of $5,000, I would directly credit that piece of equipment. I would directly debit the owner's draw as far as that goes, because the business no longer has access to it. I do not go to income summary for that. Income summary just holds your revenues and expenses. These other accounts I take out directly affecting equity. Same thing for a dividend distribution. If I distribute dividends during the month, that is going to be a direct credit to cash, a direct debit to equity. I'm sorry, it's going to be a direct credit to dividends, and then a direct effect on equity as far as that goes. Because again, that is that's cash flow going out. And as a result of that, that affects my overall position, because when I'm looking at distributing cash in the form of dividends, alternatively, I don't have that money sitting as money that can now be retained in retained earnings. It's going out. So that's just kind of a general overview. Of course, this week we got into a merchandising type of business, and really you have some specific closing entries there, but it behaves very much in the same manner. Where you've got you still have to close out a merchandising inventory just like you would in a service inventory, service business as well. That process, really is very similar, and that's the nice thing about the concepts that we're learning right now. You're going to learn some intricacies and some more detail, depending on the types of businesses that you encounter. But the financial statements are the same, really. The income statement still does what, regardless of how complex the business is, it still basically does what you initially learned in that very first basic set of financials you prepared. A balance sheet is the same way. It still is going to have to balance. It still is going to be a statement of your assets, your liabilities, and your equity. There's just more steps to that process. A statement of cash flows is really going to be pretty much the same. And it's businesses have different sets of intricacies and that type of thing, and you learn how to account for that. But really and truly, what it's doing never really changes from what you've already learned. It just becomes there's different levels of granulation and different things that you have to look at. So this is really the foundation. You've really gotten to that point at this time in the semester, and now we're going to build forward from that. So again, if you think about the closing process, I think that it makes sense, but certainly if you have any questions or if you would like additional explanation, or you just want to kind of talk through that a little bit, please let me know. I'm glad to put something else out here and try to give some examples and get into that further if you have any of those questions. Otherwise, I encourage you to do the Chapter 4 homework and really begin with a Chapter 4 practice. That's going to help you in terms of preparation for the quiz, SmartBook, and homework assignments themselves. And please let me know if I can help in any way. Have a great day. See you later. Bye.